Okay, we're going to begin our program tonight. I want to thank everyone for you coming tonight. This is being brought to you by the Small Business Resource and Recovery Center in the town of Huntington, and this is in partnership with Continental Home Loans. My name is Councilman Mark Mayoka, and I'm glad you're here to attend this program. We're going to have with us tonight Bruce Silver, who's with Continental Home Loans. He is an executive vice president, and he has 27 years of experience in the industry. He is also a mortgage banker. Today's program is a Homebuyer Seminar. It will be geared towards first-time homebuyers, and there also will be a section on programs available for veterans. The program will talk about an understanding of the current marketplace and tips and informational items that you need to know. Today was a pretty monumental event, if any of you may or may not be aware, but Ben Bernanke has publicly announced that he will not taper his quantum easing program, which means that it's likely that interest rates will fall back down. They had a little bit of a bump up in the past 8 weeks. So this could be an opportunity to get involved and buy that home because rates look like they're going to be supported as of today, and they may continue down. And any questions you have, you can please hold till the conclusion of the program. I take great pleasure in introducing Bruce Silver from Continental Home Loans, who's doing this program in partnership with the Huntington Small Business Resource and Recovery Center. Bruce, thank you for coming.
Thank you very much. Well, thank you for coming tonight. Appreciate that you're all here. Mark, thank you so much for having me on this program. So tonight, we're going to talk about a lot of different things. I start out with this screen telling you that surely it is a great time to purchase a home. It's a perfect storm to purchase right now because we know that home values have absolutely dropped over the past couple of years now, and interest rates are certainly maybe not at their all-time low, but they're at near bottom of the market. So it is certainly a great opportunity. Tonight's goal is fairly simple. It's going to start with education. It's going to talk about the benefits of home ownership and everything that goes along with that. We're going to try to identify some of the common misconceptions. You know, if you listen to enough television programs and read enough print material, you'll think that you need to have 20% down, perfect credit, and 10 months reserves in the bank, and that's just not the case anymore. And if that were the case, no one would be owning a home right now. And also to explain some of the basic do's and don'ts in the mortgage process. I've learned over my 27 years that early intervention is best. You know, there's a lot of things that you might think you should be doing now to get ready to buy a home, and they might be the wrong thing. So we'll try to help to identify some of that for you as well. Part of the discussion tonight is to stop having you look at a mortgage like it's truly a debt, which it is, but it's also a financial instrument. And you can actually create wealth and eliminate debt through properly structuring the mortgage. So that's part of our discussion tonight, okay? Mark did bring up Federal Reserve Chairman Ben Bernanke, so I just wanted to give you a background on why this is a great opportunity and why this opportunity may not last forever. Just a quick history lesson. You know, back in 2008 when the economy was in flux, the administration had to do something, and they realized that the key to recovery is housing. So how do you recover in housing? Well, you got to drop interest rates. And so that's exactly what they did. And so they took stimulus money and they aggressively started buying mortgage paper out of the markets, these mortgage-backed securities. You might have heard the term quantitative easing, or you might have heard of the term QE1, QE2, QE3. And that process is the process of the Fed purchasing mortgage paper out of the industry, out of the market, to reduce supply, create demand, lower interest rates. Well, guess what? It worked. Because back in 2008, interest rates were about 6 3/4. And as of, March, April, they had hit their all-time low, low threes. Now, Mark was right to say they recently bumped up, but today was the turning point. See, right now, the Fed is buying $85 billion of mortgage paper every month. Just think about how much money that is. And the turning point today was that there was talk that they were going to taper that down. They were going to bring that down to maybe 80 or 75 or 70 billion. And that was spooking the bond market and thinking that way we better get ahead of that, and rates started to move up pretty rapidly. And so in real short order, interest rates went from low 3s to high 4s, pushing almost 5. Well, today was a good day. Today the bond market rallied on the news. Interest rates are starting to taper back a little bit, and I have no prediction on interest rates. All I can tell you is the best time to buy is right now, okay? A little bit of housing information, just update on where we've been and where we're going. Right now, we've had 12 straight months of increases in values. This is in this nation, okay? More locally, I think we're 4.8% gain in New York State, nationally 6.5. So, you know, not a bad return. I mean, most people are just happy to stop the bleeding from their values keep dropping. So certainly what you buy now, I believe I can say with confidence, 5 years from now, you're going to be real happy you purchased it. 10 years from now, you're going to wish you found a way to buy 2 homes. You're going to get a good return, no question about it, okay? We turned certainly from a buyer's market to a seller's market almost overnight, right? There was so much inventory on the market. There was so many properties for sale. And now we're hitting sometime, like in I believe in the town of Northport, it's a five-year low in inventory. So the time to buy is now, okay? I'm going to get past some of that. I'm going to just ask a rhetorical question. What if everything you believe to be true about your mortgage, your home equity, even your college retirement planning wasn't true after all? When would you rather know about that, now or later? And the answer, of course, is we want to know about that now, okay? So, again, some more things to ponder. I just want you to think about the questions I'm about to pose to you. And maybe at the end of the presentation, you'll think differently than you answered just now. And I don't want answers. I just want you to think about it. But which is better? You know, being very wealthy or completely debt-free, and there is a difference between the two, okay? Having a big mortgage with a totally funded retirement plan, or no mortgage at all with very little in the savings account, okay? If you could afford the payments on a 15-year mortgage over a 30-year mortgage, would you do that? And most people I bet in the room would say absolutely yes. But for the right person, I could agree with that, but it's not always the right thing. Does paying extra money into your principal balance of your mortgage actually save you money in the long run? My clicker's not working. Okay. See, most of what we learned about mortgages, we learned from our parents and grandparents. Okay? What did they tell us? Make a big down payment, get a fixed rate mortgage, make extra principal payments whenever possible, and pay off that loan as early as you can. And really the question there is, you know, why did they feel that way? Well, did some research, and I'm going to talk about a book, and it'll just at least allude to it. It's a book by Rick Edelman. Rick is one of the top 500 financial planners in the country. He wrote a book called Ordinary People, Extraordinary Wealth. A good read, a good book to read for sure. And what he realized is that most of the thinking that we've come across today from parents and grandparents came out of the Great Depression. So what was happening in the Great Depression? Well, 1920s, okay, mortgages really were birthed out of loans to farmers. These were loans that had something called a demand feature. That meant at any given time, for no reason at all, the bank could take back the loan. They could call it due. Okay, that was big. Stocks could be purchased on a 10-to-1 margin. That means you could buy $10 worth of stock for $1. The other $9 was margined or borrowed. There was no regulation in banks, right? They were basically privately held institutions, no government guarantees behind them. And then October 1929 hits, and stock market drops. And all of these, pretty soon it was like a scene from It's a Wonderful Life, if you remember that movie. There was a big run on the banks. People wanted their money. They had to pay that other $9 that they borrowed. Banks weren't regulated. They were using money in the stock market as well. And so before you knew it, the bank had run out of money, and the only thing that they could do is to exercise that demand feature. So as they were lending out money to homeowners, when they ran out of money, they needed to call in those mortgages. And the result basically was that stocks dropped by 75%, more than half the banks failed, and millions of people lost their homes. And by the way, that is what birthed the FDIC. So that now if you have your money in the bank, up to $250,000, it is now insured. But back then it wasn't. So no wonder why Grandma and Grandpa didn't want you to, borrow money and keep all your money in the mattress. That's the way it was back then, okay? But the rules of money have changed. Just like it's not your grandfather's Chevrolet, it's also not your grandfather's mortgage. So, back then, they felt their retirement was like a three-legged stool. They looked at their pension, their Social Security, and the equity they could build up in their home and their savings as enough to retire and live on. And that might have been well and good for them, but for us today, it's not. Here's a statistic for you. Did you know that there are over 16 million households in America that are owned free and clear, no mortgages, and the homeowner lives below the poverty line? This is Grandma and Grandpa struggling to just pay the taxes on the home. By the way, this is why you see that bombardment of reverse mortgages out in the industry. That's people are, using their home to just to live. That's what it's about. Look at the facts, right? In America, we have had a negative savings rate mainly from 2005 to 2010, which is the first time since the Great Depression. We finally got it right around 2011 until now that we're starting to actually save a little bit. But in that period, that 5-year period, for every dollar we were making, we were spending $1.25. It was horrendous. But people were using their home as a piggy bank because the values of homes were growing up so dramatically that even if you got into debt, your home went up in value, rates dropped, you refinanced, you pulled it back out, you got back on your feet. Most people should have saved money, but they just ran up the debt again. And then in 2006, that all ended. The average household has less than 1 month's mortgage payments left in reserve. Sad statistic. 65% of Americans need their next paycheck just to meet everyday living expenses. 97% of U.S. families don't even have a current savings plan in place. No plan. Just, day by day, week by week. 77% of workers say they're going to work during retirement, when only 12% do. And there's no jobs out there anyway for them. Right? 3/4 of workers aged 55 to 64 have less than $56,000 saved in retirement. And I promise I'll pick up, it won't be all depressing, but these are the harsh facts and you need to know about them. Right? The average monthly Social Security benefit, $963 per retired worker. That might work somewhere out west, not going to work in Manhattan, and in New York, not going to work. Pensions are down from 85% in 1982. 1982, 85% of workers had a pension. It's down to 34% today. Not going to rely on pensions. 94% of families don't even have a will, which is really the only way to really protect your assets and your children. 20% of Americans have credit cards that are totally maxed out. Here's the good news, bad news one. We're living longer, but you know what? It costs a lot more money to live longer. Right? So understanding that you need to harness the power of your mortgage to be able to create wealth for yourself and eliminate debt is the key. So I'm going to pose some questions to you. You tell me, as an investment opportunity, how much money you would spend in this investment. So here we go. So how much money would you deposit into this investment? You can determine the length of time and the amount you want to invest into this on a monthly basis. You can contribute more than the minimum, but never less. In fact, if you contribute less, you'll forfeit all previous contributions. The monies deposited are not safe from a loss of principal. The monies in the account are not liquid. Your income tax liability actually increases every time you contribute into this investment. The monies contributed have a 0% rate of return. And when the investment is fully funded, there's no income paid out. So raise your hand if you would invest in this investment. And of course, there's no hands going up. The scary thing is that most of Americans have their money in this investment. Does anyone know what this investment is? This is a fixed rate mortgage. Think about it, right? You can determine the length of time and the amount you want to invest. You can take a 30-year mortgage, 15-year mortgage, 20-year mortgage, right? You can contribute more. You can always prepay it, but you can't short the bank, right? If you short the bank $50 a month for 3 months, you're going to get a foreclosure notice. Monies deposited are not safe from a loss of principal. Well, what does that mean? Well, if you bought a house in 2006 and put $100,000 down, you probably lost all of that. The equity wasn't safe. Right? Monies are not liquid. You put down a down payment into your home, that money is not moving till you sell that home. okay? This is a tricky one. The tax liability actually increases every time you contribute. That's because you're paying less interest, which is a good thing, but less tax deduction. Nobody pays you interest. It's a 0% rate of return. So I want you to think about it. If you got $100,000 to put down that's in an ING account making 2% today, at least it's making 2%. But if you take that whole $100,000, deposit as a down payment into your home, is anyone going to pay you 2% interest on it? Not only they're not paying you 2%, they're not paying you anything, right? And so, and when it's finally paid off, the only thing you can do is have a mortgage burning party. There's nothing paid out for you. So you have to understand how to harness that opportunity to finance properly without getting in trouble. And one thing I'll tell you is that I'll never get somebody in over their head. It's not for me to tell you what to finance, but it's for me to guide you as a mortgage professional, okay? 5 steps towards wealth creation, okay? Starting with emergency cash. You really want to create wealth in your life, you have to have something on hand. You know, the boiler breaks, the roof goes, the car goes, that's emergency cash. Got to have that. Elimination of bad debt. And bad debt with quotations, that's all your consumer debt. That is your car loans, your school loans, your personal loans, your credit card debt. Well, if there's bad debt, if there's such a thing as bad debt, is there anything that's good debt? Well, I can tell you that I believe that mortgage interest debt is good debt because you can tax deduct it. You can utilize it and create wealth from it. Having 3 to 6 months of liquid reserves, all important. So after all your bills are paid for the month, having 3 to 6 months left over, very key. Now, if America could get the first 3 steps down, we'd be the greatest nation on the earth. The fact of the matter is that, as I gave you those statistics, it's not where we're at, right? Most people are living day to day, paycheck to paycheck. Debt-free, new definition. Debt-free is having eliminated all of that debt and maybe just having your mortgage debt. Now, isn't debt-free having no debt at all? But isn't debt-free also if you had a $400,000 mortgage and $400,000 in the bank account to pay off that mortgage? Isn't that also debt-free? You're just choosing to utilize the debt to create a tax write-off to create wealth with the other $400,000. I mean, so there's great opportunity when you start to understand, you know, what's before you. And then reaching your freedom point. And reaching a freedom point is something that may take 1, 2, or 3 generations. That's having accumulated enough wealth that you are just living off the interest and never have to work again. But that'll make us lazy Americans, so we don't want to do that either. Another book I want to just give tribute to is Missed Fortune 101 by another top 500 financial planners, Doug Andrew. And Doug talks about when you invest in anything, whether it be a mortgage or anything else, it needs to pass a prudency test. So what is a prudent investment? Well, a prudent investment has to have at least 3 characteristics. Okay, when you invest your money, you want to find out, you want to make sure that it's liquid so that, you know, if you need it back in an emergency, you can get to it. So can I get back to my money? Is it safe from a loss of principal? And does it have an interest rate of return? Of course, if you can get tax benefits on top of it, whipped cream on the cake, but the whole key is that having a liquid, safe rate of return is key. Now think about it. Your bank accounts, which are now FDIC insured, they're prudent investments. Why? Because, well, they're liquid. You can pull out the money anytime you want, right? They're safe. They're FDIC insured. And they do make a rate of return, not the one we want, but it makes a rate of return. Now, the minute you take that money out of that bank account and deposit as a down payment on your home, it's no longer liquid. That went to the seller to purchase his home. It's no longer safe, necessarily. If values drop, you're going to lose it. And no one pays you interest on it. So again, you know, if you have enough money to put 20% down, by all means, I'm not going to talk you out of that. But if you have only enough money to put 20% down and pay your closing costs, and you're sitting there with a stockpile of credit card debt, and you're going to wait for your next paycheck to make the next mortgage payment, I don't think that's a prudent thing to do. Right? Maybe putting half of that down, maybe putting 10% down, and getting rid of some of your credit card debt might be a more prudent thing. Well, we're going to skip over inflation and all that right there. Step over that. Okay. Again, I'm not advocating that you get in over your head as purchasers, okay? For us as lenders, we've always held to the adage of suitability over eligibility. And what do I mean by that? Well, you see, back in 06, 07, 05, 06, 07, everybody with a pulse was eligible for a mortgage, right? I mean, you basically need a Social Security number and a pulse, and you had a mortgage. But not every mortgage was most suitable for people. So the idea is to figure out what is right, because you see, when the subprime mortgage world came out, it was a free-for-all, and that's what got us into trouble, okay? There was such easy access to money that, I mean, bad credit, good credit, no down payment, you were mortgageable, and that was a problem. Back in that day, there was over 500,000 loan officers in the country. And through the subprime bubble and all that hit, it's down to under 90,000. So just think about that as being on my shoes, that 80% of my competition has left the building. Pretty good thing. And now you have to be licensed. If you're a loan officer, you have to be licensed by the state and by the federal government. So much more regulation, which is part of the whole Dodd-Frank thing, which I think was good for the industry. It needed to be cleaned up a little bit. A little more discussion about interest rates, because I will tell you that Mark might be right that interest rates are going to ease back a little bit. I don't see them getting back to 3 1/4, 3 3/8. I don't see that. I do see them maybe heading back to the low 4s, but again, there's no crystal ball. Right? But I want you to understand what the effects would be if rates do continue to move up. And by the way, I believe what we just saw today with Bernanke and everything else is temporary. I do believe as the economy improves, and rightly so, they'll have to stop tapering. When people go back to work, they're going to start to raise rates, and we're going to need that for all of us anyway. We want to make more money in our bank accounts anyway. But here's what happens. If interest rates move from current levels just 1% higher, so let's just use, and I think tonight I'm going to use 4.5, 4 5/8 on my interest rates scenarios. So if rates move up just 1% from current levels, that's going to decrease your average home buyer's purchasing power down by $38,000. Just a 1% increase. And we had more than a 1% increase from its all-time low, right? Let me say it to you this way, right? Let's take a $350,000 loan amount at 4.5%. That mortgage payment for principal and interest is $1,773. If that goes to 5.5, it's $1,987. That's an increase of $213. That's going to pay your utilities, right? So you can see how the affordability index will drop, right? People's ability to purchase homes are going to drop dramatically. So if you were a $350,000 purchaser, you're now a $312,000 purchaser. And that's why the time to purchase is really now, because who's going to be able to time the market? You don't know. So some of the advantages of home ownership, and some of this stuff is basic, but I think it's important to kind of bring it out. Owning a home allows you a number of different things. First of all, it allows you to invest in an asset that over time will grow. I mean, if you take the last 100 years and you look at real estate, it's averaged over 6% return, last 100 years. And just look at what's happening now. I mean, we had this downturn. And if you didn't purchase a home in this downturn, then consider yourself fortunate. But we're right back up there. We're close to, nationally, we're 6.5 last year, and 4.8 in Long Island. And parts of Long Island are even more than that. It's going to provide a stable living environment for you and your family. I mean, no longer is the landlord going to tell you, hey, you can't have a pet, you can't paint that room, and you can't put that closet there. This is your home. Your home. You can create significant tax benefits by owning a home. I'm going to get into a little bit of that in a little bit later. And it's really just, fulfilling the American dream. I mean, it's just, I will tell you that typically people who purchase homes and take pride in that home take better care of that home than a tenant would. Just a fact. I'm going to skip over that. Some of the mortgage do's and don'ts, and this is something that I definitely think if you are considering purchasing a home, again, some of it's basic, but I want you to hear what I'm telling you here, because sometimes people make mistakes up front and it costs them dearly. So first thing right now is that I would tell you that if you're looking to purchase a home and you're trying to save money and you don't have a lot saved, then for right now, I would just start making the monthly minimum payments on your credit cards and start banking the difference. Certainly make the minimum payment, but don't try to pay a $4,000 credit card down to $3,000 before you meet me. I'd rather see you keep that extra $1,000 in the bank and pay the $30 monthly fee. Okay? At some point after we consult, I might tell you to pay that down, but at this point, having money in the bank is probably the most crucial thing you can do to purchase a home. You need to have money in the bank. Pay all bills on time. I'm going to tell you, we're going to talk about credit in just a bit. You know, credit can be impacted so severely just by having one late payment. Do you realize that if you had just one 30-day late payment in the most recent 12 months, and you started with a 750 credit score, we'll say, it could drop you up to 100 points, just having one late payment. Funny thing is, the higher your credit score, the more impacted you are. So you definitely want to make sure that you're paying everything on time. It's so important. Consult with your loan officer, whoever that might be, before you move money around, because every lender is going to look to see a paper trail of where your money went. So if you're putting it from here to there, they're going to want to paper trail that, and it's going to put you through a lot of work. So I would definitely tell you to do that. Here's some of the don'ts. Don't cancel credit cards. Okay, if you cancel your credit cards, you could again severely impact your credit score. We'll talk about that in just a minute. Don't apply for new credit cards, because every new inquiry into your credit report makes it look like you're looking for money, and maybe you were denied, and so it's a negative impact. On those credit scoring models, it will impact you negatively. Don't take cash advances, right? You know, you get all those sign and go, you know, here's a quick $5,000, Bruce, just sign here. It's 0% interest for 30 days, right? And then you take that money and deposit in your bank account. That's a problem. See, because at that point, you're taking borrowed money to go borrow a mortgage. You can't borrow money to borrow money. If you can help it, and you haven't already done this, don't co-sign a loan for anyone else. Think about if you co-sign a loan for somebody else, you're at the mercy of them making that payment to help your FICO score. Now, we've had many situations where, you know, Uncle Charlie co-signs the loan for his nephew defaults the car loan, he's embarrassed to tell his uncle, and it's not till months later that the uncle gets the letter in the mail that says, hey, you know, we want our money. And he's been impacted severely. It's hard to fix that. Don't deposit cash. Cash is a no-no, right? If you're going to borrow money from a bank, the bank wants to know that you're using your own money. And if you do cash, there's no paper trail to prove that. You might have been saving your paycheck every month and putting in your safe deposit box for whatever reason. I don't know why you would do that. But then if you decided, okay, I'm going to buy a home now and deposit that cash, that's a problem. So you definitely don't want to deposit cash into your bank account. Real important. And we're going to move on to some of the other aspects here. Listen, are there realtors in the room? Raise your hand. 2 realtors. Any realtor will tell you that if they're going to take a home purchaser or a potential home purchaser out into their car and spend gas at $4 a gallon, they're going to want to make sure that you're a true bona fide buyer. How do you do that? Well, you got to get pre-approved. Right? So the pre-approval process is the first step in the home buying purchasing process. Right? Pre-approval tells you a number of things. First of all, it tells you if you're even qualified. Maybe you're not ready. Maybe you're 6 months away from being ready because you don't have enough money, you don't have good enough credit. Right? But that's what the first step is. Let's find that out. And by the way, we won't kick you to the curb. If you're not ready, we'll just help you figure out a way to get ready. Okay? Tells you how much you qualify for. And by the way, that's kind of a tricky thing because typically your average home buyer comes in and qualifies for more than they want to spend or more than they're comfortable with. And that's a good thing. I tell people there's usually 3 numbers. There's the number that the paper says you qualify for. There's a number that you think you qualify for. And there's probably something in the middle of the 2 of those numbers that's the right number. But until we get you through the process of understanding tax deductions and the like, you won't really be able to appreciate that. So that's why pre-approving is so important. How much cash does it take? I don't mean how much of a down payment does it take. I mean how much cash in total. What's the down payment requirement? What's the closing cost requirement? What are the other ancillary items that are going to be hit with, like home inspections and attorney's fees and the like? Okay? What's the monthly payment going to be? I mean, so important, right? Everything's about monthly payment. And then, do you need to repair any credit? I mean, at this point, again, you don't want to find the house, fall in love with the house, sign a contract, and then find out you have a credit problem. Right? And certainly the realtor's not going to appreciate that either. The steps in the home buying process, kind of basic stuff, but stuff you should know, right? Starting with a good agent. There's 2 great agents in the room, so certainly avail yourself if you want to. But there's a great number of real estate agents on Long Island. We've got some of the best out here. So finding a really good real estate agent. You want to find a good lender, prudent lenders, triple rated with the Better Business Bureau. You want to make sure that you have done your research on that. Get that pre-approval letter, so important. Make your offer. Assuming the offer is accepted, you want to get a home inspection done. Okay, make sure that that house is not falling apart. You want to hire a really good real estate attorney. I think we have at least 2 real estate attorneys in the office, in the room tonight. So definitely there's some great real estate attorneys that we can get you to. And then sign that contract of sale. Okay? After you've signed that contract of sale, now you're ready to apply for your mortgage. So the mortgage process goes this way. Contract of sale. Do your mortgage application. We do the appraisal on the property, make sure it's worth what you're paying. We process the loan. That means we take the pay stubs, the W-2s, the bank account statements, the retirement statements. We put that all together, and we send it to an underwriter for an approval. Underwriting is the crucial part. That's where the loan gets approved. Then you're in pre-closing, which means your approval might have a couple of conditions on it. You clear those conditions, and boom, you're closed. I'm going to tell you that that typically it's probably a 4-week process if everything goes right, from the application to the written commitment. From the written commitment to closing could be anywhere from a week to 2 weeks. So overall, it might be a 6-week process, but I got to tell you that many lenders are inundated these days, and so you probably want to give yourself more like 60 to 90 days in this process, just to be aware of it, because it is busy. The mortgage requirements, I want you to think of like the 4 legs of a table. When you're looking to be approved for a mortgage, the bank looks at 4 main things, right? They're going to be looking at your income, the credit score, your assets in the bank, and the appraisal, all right? And they're all equally important, okay? When you come to be pre-approved, you should be prepared to bring your lender some of these documents. I'm not going to go through the exhaustive list, but I'll highlight a few of them for you. Certainly, if you're going to see a bank, you want to have at least 2 months of your bank statements ready to go with all the pages of that bank statement. You want to have your pay stubs. If you're a salaried person, you want to have your pay stubs for 1 consecutive month. You want to have W-2s or 1099s if that's how you're paid for 2 years. You want to have 2 years of federal tax returns. You want to have your retirement accounts available, most recent quarterly. And are there veterans in the room? There are veterans in the room? I think there's 1 veteran, yes? 1 veteran. Thank you for your service, sir. The DD-214, which is the discharge paper, the honorable discharge. So important if you're a veteran. Let's have a quick discussion about credit. Credit is such a crucial piece to the home buying process. Without good credit, you're just not going to buy, I'll tell you right now. So your credit is analyzed by your willingness and ability to pay back your debt, okay? Credit report reveals a number of different things. It talks about your current financial obligations. So everything's going to show up pretty much for your whole life. From stuff that's back in the 70s will still show up on your credit report, okay? Late payments definitely show up on your credit report. Unusual circumstances, Bill Smith Jr., Bill Smith who's not related to Bill Smith 1 and 2, might have commingled credit, unusual circumstances. You want to find that out up front so that you can address those issues. Hey, that's not my credit. Okay, let's find out why. Bankruptcies are going to show up on your credit report. Judgments, liens, charge-offs, collections all show up. And then FICO scores. And we've all heard of FICO scores before, but probably nobody could really tell me what the heck a FICO score really is. So what does a FICO score mean? Right? The FICO score is a predictor. And really what it's doing is it's predicting the statistical chance of anyone in the room becoming 90 days late on any particular debt over the next 24 months? I'll say it again. How likely are you to go 90 days late over the next 24 months on any of your debt? And why is 90 days late important? Because that starts the foreclosure process. If you didn't pay your mortgage for 90 days, you'd be in foreclosure. And that's what the FICO score really is analyzing. How willing are you to pay back debt? How likely are you to become 90 days late? Okay? Each score is specific to each bureau, so there's typically 3 bureaus: Experian, TransUnion, and Equifax. Okay, so each score is unique. The scores range from 300 to 850. In all my years, I've never seen an 850. I've also never given a mortgage to a 300, so don't be a 300, right? Higher the score, the less likely are you're going to default. And the score is basically taking a snapshot in time. So your scores will be a moving target. You know, if you're a person that likes to use credit card for, say, air miles and run up the credit card debt for the month, but at the end of the month reconcile it, your FICO score is likely to be a higher FICO score in the beginning of the month than it would be at the end of the month because you've run up the credit card debt. So be cognizant of that when you're having your credit run, right? You might want to tell your lender that, listen, I'm about to pay off this debt here, so maybe we should hold off. Important. Here's how the odds look, right? A score of, say, above 800, you have 1 in 1,485 people is going to become 90 days late. But watch how quickly it falls off, even with pretty good FICO scores. Like, for instance, someone with a 720 to a 799 FICO score, those are A+ FICO scores. But look at the odds. It goes from 1 in 1,485 people to 1 in 649. Pretty amazing. 680 to 719, 1 in 112 people. It's going to become 90 days late. Those figures are a moving target. Yeah, yeah, absolutely. They're a moving target for sure. Yeah, they're a moving target. 100%. Scores of 620 to 679, 1 in 47. And then you get below 620, 1 in 15 people are going to default. You know, not too long ago, 620 was considered you're marginal, you're going to get in at 620. Pretty much every lender across the country has raised the bar on that to about 660. That's kind of the score you want to be around. Doesn't mean you can't get a mortgage with a 620 FICO score. It just means it's going to cost you a little bit more money, a little more down payment. They're going to want some more meat in the game, so to speak. But maintaining good credit is the key to your financial success. You have to understand it's not just about getting a mortgage. When you're going for life insurance, they're running your credit. When you're going for a job, they're running your credit. When you're buying a car, they're running your credit. When you're getting a mortgage, they're running your credit. And everything's going to cost more for you if you don't have good FICO scores. So it's definitely worth it to work on that credit report, okay? Just to explain to you a little bit more of how the FICO score model works, right? 35% of your credit score is based upon your payment history, how you pay back your debt. It's important, but it's really 35% of your score. The next one is the one that gets people. This is one I told you earlier, don't cancel credit card debts, because you see 30% of your FICO score is the proportion of how much you have available in credit to how much you have used. So I've had some people come to me and say, look, I had $50,000 worth of credit card availability. I thought you might use that against me, so I canceled all my credit cards. And I'd be like, my goodness, why did you do that? And you might have a $50,000 worth of credit available and only a $5,000 balance on the sum total of that. But if you knocked all of those off and just kept one credit card that was maxed out, this scoring model is not human. It's like an idiot savant. It sees what it reads what it sees. It doesn't know that a month ago you had $50,000 worth of credit card availability. It knows today you're maxed out, and you just shot yourself in the foot. So it's so important, again, part of those do's and don'ts, to know why you wouldn't want to pay off or cancel credit cards, right? The types of credit in use will affect your FICO score to the degree of about 10%. So, if you have a mortgage in the past, that counts greater than, say, a car loan, and a car loan greater than a major credit card, and so on and so forth. All right? New credit is about 10% of your score. So if you're trying to increase your FICO score, going out and getting 10 brand new cards is not really going to help you so much. Length of time, length of credit history is very big. Got a long track record with no lates, it's going to help your credit score. So just things to think about, okay? I'm going to talk a little bit about some of the products that are available to you as home buyers. You don't have to necessarily be a first-time home buyer for some of these products. Actually, for most of these products, you don't have to be a first-time home buyer. You've heard of Fannie Mae, Freddie Mac, right? Quasi-government institutions there's a lot of talk about them right now, making them privatized. I don't think that's going to happen. I think that would be a mistake right now. But at this point, with those two programs, you can put down as little as 5%. Okay? They would require, with less than 20%, to have private mortgage insurance, PMI on those. Depending on what your income level is, the PMI is actually tax deductible today. If you're putting down as little as 5%, you want to have a pretty good FICO score, somewhere around 700. The PMI can be actually paid in one lump sum as a single premium. So if you really wanted to not have the issue of PMI, and a lot of people are just, that's what they don't like about it. I don't want to have that extra monthly payment. Well, you know what? You can buy it all out up front. So you can take your PMI in one fell swoop. So if you were somebody who was going to put down 10%, I might advise you to put down only 5%, get rid of your PMI. Why not? Rates are cheap. Money is cheap. You know, you think about, for every $10,000 that you borrow today, it's going to run you about $52 a month for every $10,000 you borrow. And that $52 a month is tax deductible. So it's probably taking your average person down to a cost of about $32 a month. So why not? As long as you can afford it, why not? Right? Today's rates, again, before today, this presentation was, before Bernanke spoke, but your average Fannie Mae rate probably 4 3/4 this morning. Probably by tomorrow morning, it'll be down about at least 1/8%, 4.5%, and probably trending lower. I mean, again, no one has the crystal ball, and that's why I say to you, I've seen it for 27 years. Rates are always quicker to go up than go down. So don't sit there thinking you're going to time the market. It just never works. Fannie and Freddie will allow you to do single-family up to 4-family properties. You can do condos and co-ops. You can do investment properties as well. Now, the FHA, been the big buzz too. FHA is a great program. The FHA came out right after that crash of 1929. The FHA jumped into the market about 1934 to start insuring loans to lenders so that they would start lending money again, and this was a big help. FHA loans are insured by the Federal Housing Administration. That's the FHA. Their guidelines are a little more relaxed so that, if you're a little dinged on credit, they'll have a little more leniency with that. Easier to qualify for. Lower credit score requirements. Lower asset requirements. But remember that they're not the lender, okay? The bank is lending the money. They're insuring the money, okay? The insurance is not cheap. So one thing about it, they do give you, they give and they take. They'll allow you to put as little as 3.5% down, but they're going to make sure that they're well paid for that. So they get an upfront insurance premium of 1 3/4% of what you borrow. Bad news is you have to pay that. The good news is you can roll that into your mortgage. So if you're borrowing $100,000 to make it easy, the MIP would be $1,750. Well, instead of lending you $100,000, we would lend you $101,750 to cover that mortgage insurance. So you don't come out of pocket with it. The monthly is the one that you will come out of pocket with, and you can't avoid it. Regardless of down payment, you're going to pay it. If you put the minimum down, it's going to be there for the life of the loan, so you want to be careful that you, if you're going FHA, that you know all the facts. So you want to talk to your lender when you're applying for these different programs to understand the facets of each program, okay? It's a common first-time homebuyer product. It only requires 3.5% down. The money can be gifted. This is a beauty of this. Let's say you did store all your money in your safe deposit box. Well, the good news is mom could give you a gift, so you don't have to worry about using your own money. You could get gift money for it, okay? The minimum credit score for an FHA is, believe it or not, as low as 580. Remember, these loans are insured by the government, but they're going to require, if you had a 580 FICO score, you better be Uncle Charlie, the guy who co-signed your nephew's loan, and that's why your FICO score is low. You're not going to get a 580 FICO score and be late on all your debt. But sometimes there's unusual circumstances where your FICO score is lower than it's supposed to be because it was out of your control, right? So we will do 580 FICO score, but you're going to need probably a 20% down payment, They don't require reserves, money left over in the bank, although I think it's a good idea. Go past that. You can actually have non-occupying co-signers, people who, like mom and dad, family members that would co-sign a loan. So, maybe you just started a second job to help qualify, and we can't use that second job income, but mom and dad would help you. You can do that. These loans are all full documentation loans. They're not those subprime loans. All right, they're all for owner-occupied. You can't buy investment properties with an FHA mortgage. Okay. I'm going to talk to you about a specific FHA product just to give you something to sink your teeth into, something tangible to walk away with and think about, right? So I'm going to set up a scenario of doing a FHA loan and building some closing costs into the picture. That's called a seller's concession. That's where you would build into your sale price some of your closing costs, okay? So the scenario we'll use is a purchase price of $350,000, okay? And we'll assume that the price was agreed upon at $335,000, or the seller is going to then give you a $15,000 seller concession. So the contract price is at $350,000. The seller has agreed to take out of his $350,000 $15,000 towards your closing costs. That can happen. Willing seller will do that. So remember, your FHA down payment is 3.5%, so it's $12,250 down. That leaves the remainder of $337,750 for the loan. Remember, that loan has got the mortgage insurance of 1 3/4%. In this case, it's $5,910. Again, the bad news is you got to pay $5,910. The good news is I'm lending it to you. So you're really going to be borrowing $343,660. And closing costs of $15,000 will be covered by the seller. So if you think about it, you're basically purchasing this home for the down payment. Because on a scenario like that, that $15,000 will pretty much cover all your closing costs. So not too bad purchasing a home for $350,000 with an outlay of maybe $12,000 to $15,000. Not too bad. Okay? But what does the payment look like? I mean, can I afford to do that? Well, we're going to use the same scenario. It's the same house, $350,000 house. We're going to use $8,000 taxes. We're going to use a 4.5% rate. That's the scenario I'm setting up for you. Okay? So the mortgage payment for principal and interest would be $1,741. The property tax is $667, which is $8,000 divided by 12. Homeowner's insurance, about $1,200 a year. The mortgage insurance, now the second one kicks in, the monthly mortgage insurance is $379 for a grand total of $2,888. Okay? And it sounds like a lot of money, but hang in there for me for a second. See, I say stop investing in your landlord's future, invest in your own. Your landlord loves you, especially when you pay on time, right? Because you're paying down their debt, you're helping them build equity. Consider this. Does anyone think you're going to buy the Taj Mahal or rent the Taj Mahal for $2,000 a month? You don't. You basically, you might not even get a full home. You might be renting an apartment or a part of a home for $2,000 a month, right? And if you did that for 7 years, you've just laid out nearly $170,000. And all of that for no tax write-off, no equity built, just for a roof over your head. So I took the liberty of working through that same scenario and telling you how much of a tax write-off you would get in purchasing that home. Right? So if you purchased that home and paid that $2,888 mortgage payment, well, that comes with $15,351 of mortgage interest, comes with $8,000 of real estate taxes. And until further notice, they're not taking any of that deduction away. So you see, Schedule A of your tax return becomes your new best friend because you can now itemize your deductions right there. So what I'm doing, again, for the purpose of the discussion tonight is I'm using a 33% tax bracket. Okay? So if that's your write-off, which is $23,000 a year, at 33%, and then dividing that by 12 to give you a monthly number, something to sink your teeth into, it's about $642 a month. So let me explain. When you rent and pay $2,000 a month, your tax benefit is zero. And I don't know if you can hear the little guy crying in the background, but that's basically how you would feel because you're getting nothing for that, just a roof over your head. Now, you purchased that home for somewhere between $12,000 and $15,000. Yes, your payment's higher by $888, But every time you make that payment of $28.88, you're really, for all intents and purposes, getting back $642 in cash. So effectively, that payment's down to $22.46. It's not that far away from $2,000, right? And don't forget about the fact that 10 years from now, that home is going to be worth more, and it's going to be your home, not your landlord's home. Incidentally, not only are you paying back the interest, you're paying back principal. And you're paying yourself back. You're paying the mortgage back. That's money in your pocket. It's not tangibly in your pocket, but it's in the equity of your home. Well, the first year alone, it's $5,500. Right? So that's another $400+ a month that you're putting back into your pocket as a result of making a $28.88 payment. Thank you. You know, so certainly great opportunity and a good reason to purchase. Let's talk about amortizing the loan. The payback of the loan is the process of amortizing the loan. So again, same home, same scenario. You know, you start out with that $343 mortgage or whatever that was. Well, at the end of 9 years, the mortgage balance is down to $283,541. That's what you paid back, right, after 9 years. And again, without a crystal ball and not knowing where the values are really going to be, I used very modest appreciation rates, right? So let's take a look at the next 9 years. Let's say in the first year, your 350 home appreciates only 2%, and it's already done more than that this year, right? And let's say in year 2, it's 2% again. In year 3, it's only 2%, very modest. Year 4, 2%. Year 5, 2%. Year 6, maybe it gets to 3%, real modest. Year 7, 3%. Year 8, 3%. By year 9, maybe you made 4%. So that 350 home, 9 years from now, is going to be worth $439,000. And I got news for you. It should be worth a whole lot more than that. Right? But look what happens at the end of 9 years. What I just showed you was that at the end of 9 years, your mortgage balance is down to $283,000. And that home value is probably worth $439,000. That's $155,000 plus that you gained by making the decision today to purchase and not rent. That's after-tax dollars. How long does it take to save that much money? Raise your hand if you have school loan debt. Some school loan debt here, right? Guess what? Buy a home, eliminate debt. Remember the first thing we talked about? Eliminate debt, create wealth, tax deduction. That's what you do. That's the benefit of home ownership, amongst other things. I'm going to get past this program here. This is another program through the FHA. I'll touch on it briefly, but it's basically a rehabilitation loan. It's a loan that has the same requirements as the regular FHA loan with 3.5% down, but it has an additional component that allows you to rehab the home, refurbish it with borrowed money. This works great when you buy a home in a great market, great neighborhood. It's the worst home in the greatest neighborhood, right, that you might be getting $150,000 below value, and it only needs maybe $60,000 worth of work. That's your loan. Because we'll lend you enough money to borrow 96.5%, which is 3.5% down, and money to rehab the home. Great loan. FHA mortgages are also assumable. This is pretty neat. I mean, a lot of people don't even think about this feature with an FHA mortgage, but you understand that it's an assumable mortgage, which means at the end of the day, if you wanted to sell this home, you can not only sell your home, but you can sell your mortgage along with the home. It's assumable. Right? So just take the scenario. Let's say you end up closing at 4.5%. Well, I do not have a crystal ball, but I do believe 5 years from now, you're going to see rates back where they were in maybe '08. So maybe you're just going to see a 6.5% interest rate market 5 years from now. If you decide to sell your home 5 years from now, not only do you sell your home, but you sell your 4.5% mortgage to your new home buyer, right? And they get to take it over at the same place you left it off at. So if you took a 30-year mortgage and you've paid the first 5 years, they're not inheriting a 30-year mortgage, they're inheriting a 25-year mortgage. So that heavy interest in the beginning, taken out. It will definitely give you the opportunity to sell your home for a premium, I think, right? Great opportunity, okay? With the FHA, because these loans are 100% insured by the government, let's take the other scenario. Let's say rates drop like a stone again. Let's say they go into the 2s. I hope that doesn't happen, because if it does happen, it means the economy really tanked. It also means your home value dropped like a stone. And for most people who have a mortgage, If they're upside down, if their mortgage balance is here and their home value is here, they can't do anything even no matter how good the rates are. But with an FHA mortgage, there's no requirement to reappraise the house, so you actually could take advantage of the lower rate. It's a great product, okay? It's just stuff you should know about. This is a first-time homebuyer program. So this one, Sony May, State of New York Mortgage Agency, very good, very popular first-time homebuyer product. It's a 30-year fixed rate. It's right now it's running at about 4 5/8, but it's typically below market in interest rate. It requires only a 3% down payment. It's not FHA, so it doesn't have those 2 insurance premiums. That's what's nice about this one, right? It's 3% down. It does have PMI. You can have almost all gift money. You have to have 1% of your own money in the transaction. The guidelines are a little easier. They can go down to a 620 credit score. Okay, they lock in for 100 days on the interest rate, so if you're concerned about rates, it's a good program, right? You can also get some closing cost assistance through this loan. They call it a down payment assistance loan, which is basically an interest-free loan that's the minimum of 3% or up to $10,000 that you can get from the state of New York. They attach it as a second lien against the property, but if you stay in that house for 10 years, it's forgiven of you. You don't have to pay it back. So it's a very good loan, right? They do have purchase price and income limits, so you got to be careful that you qualify. Today's rate's 4 5/8, 0 points. If you do the down payment assistance loan, they bump the rate up to 5%, so you do give up a little premium on the rate, but you're getting that extra $10,000, not too bad. Here's the last segment of the program tonight. I'm going to talk about the VA loan. We do have a veteran in the room, so it's timely and it's good. To me, the best loan on the market, bar none. This is it. And so even if it's not for most of us in the room, it's probably for somebody you know. Okay? So I want you to maybe take a note or two or just tell a friend. Okay. First thing is, it is like any other mortgage. It's a 30-year fixed rate mortgage. There's not much to it as far as that. It's a very good interest rate. Only veterans and veteran spouse qualify for it, so you can't have a veteran and a veteran's friend. Okay, it's got to be the spouse. Can't even be the fiancé. It's got to be the spouse. Or you can have 2 individual veterans purchasing together. But you can't have a veteran and a co-signer that's not a veteran. Okay? Do you have to be a first-time home buyer for a VA loan? You do not. You just can only use the eligibility one at a time. So if you purchase a home with a VA mortgage, you have to sell that and then reuse your eligibility. If you've already used it, not a problem. Okay? Credit scores, there's no reported credit score. This is the thing about a VA loan, is that they don't post a minimum credit score. It's based on a number of factors. There are certainly veterans, not just veterans, there's people in general who just don't believe in using credit, conventional credit. So you could build up a rental history, you could show insurance bills, you can show other utility bills, cell phone bills, and use that as alternative credit and get a VA loan. DD 214 is your honorable discharge, okay? And again, we talked about no co-signers, right? Here's a great statistic, Mark. I don't even know if you know this, but Suffolk County has got the 2nd highest population of veterans in the country, only second to San Diego. Nearly 120,000 veterans in Suffolk County. Should be proud of that. We've got a lot of heroes here. And these loans are 100% insured, not insured, they're guaranteed by the Veterans Administration. So as a lender, anyone doing a VA loan is more willing to lend on it because they're getting government guarantees on that loan. Right? This is important. I'm going to read this verbatim for you because this came right out of the VA guidebook, that more veterans are qualifying for the benefit. Reserve or National Guard members who are called to active duty under Title 10, which is in support of a war, which is where we have been and where we are, need only 90 days of service of active duty to qualify for the benefit versus the normal 6 years. So you see, in the past, if you were Army Reserve or National Guard, you had to serve for 6 full years to have VA benefits. Now, if you were in Afghanistan and served for 90 days and you come back, you're eligible. And a lot of people don't know that. So again, it may not affect you, but it's probably somebody that you know, someone in your family or some friend who's been there. So I would say get the word out. It's a great opportunity to purchase a home, okay? And a buyer can literally get into a home with no money of their own, because you see, you can incorporate that same seller concession scenario, right? And the thing about a VA loan is that it's 100% financing. There's no down payment required, right? And there's even better news. Whether you put down 0% or 20%, there's no PMI. There's no mortgage insurance premium like the FHA has. There's no PMI like the conventional mortgage has. It is hands down a great loan. And it's got a very good interest rate too. So 100% financing, easier to qualify for, 1 to 4 family, no co-ops, only condos and approved condos. They'll lend up to $722,500. Okay? There is a one-time fee up front like the FHA has, but it is rolled into the loan. That's basically all you got there. A great opportunity. It is also an assumable mortgage, right? You can also streamline it, so if the values drop, you can do that same thing as I talked about with the FHA, and it's a wonderful loan, okay? I'm pretty much concluding with my program now. I certainly thank you for attending and the opportunity to explain to you. Yeah. Yes. Yeah. Right. Yeah. Yeah. Mm-hmm. Right. Yeah, well, thank you so much. Well, Mark, thank you so much for having me. I appreciate it very much.
I want to thank everyone for coming to another program brought to you by the Huntington Small Business Resource and Recovery Center. And let's please give Bruce Silver a hand for his presentation. You know, the program discussed current market conditions, the mortgage approval process, and how to deal with your FICO score and how to improve it. And you've brought out a great point about veteran issues, and we're going to have that in the town of Huntington. We're going to put that on our website where veterans in Huntington or outside of Huntington, Suffolk County can find this important information. I hope you all found the program informational and helpful. Bruce will be here to answer any questions that you may have. I'm Councilman Mark Mayoka. I want to thank you for coming, and this concludes our program for this evening. Thank you again.